Robschild. No investment advice. Welcome to the show where we view financial markets using technicals, macro, Ben Graham's investment philosophy, and crystal ball gazing. Today is Monday, October 14th, 2024. There's not a lot of charts that I want to read into too deeply today because of today's episode's first note, which is that the bond market is closed. With bond markets being closed, it makes all other markets sort of you have to take all of them with a huge grain of salt. There are some interesting things worth talking about though today, and we'll get to them. But it is Monday, which means, that's right, we read through the daily reminders. 2-year, 10-year Treasury yields were inverted for over 2 years. We recently had bull steepening reversion on the 6th of September. This long of an inversion and bull steepening suggests that we're headed into a really bad recession or even a depression, because the last time this happened was right before the Great Depression. Second daily reminder, the Somme rule was triggered in July 2024. Unemployment, although still relatively low at 4.1%, it has been rising at an unsustainable pace, suggesting that, according to this rule, the recession is here. There's one other chart sort of related to this that I want to bring up with the charts when we get there as well on today's episode. Additionally, daily reminders, the S&P 500 still is a PE ratio of 30. I believe it's 30.3 now. This is without even going through a major earnings contraction period, suggesting that the S&P 500 is extremely expensive and therefore extremely dangerous to be investing in it. Fourth daily reminder, rate cut cycle began on the 18th of September with a large 50 basis point cut instead of a mere 25, suggesting that in that meeting the Fed was fearful. And for the rest of 2024, we still have 50 basis points of more cuts, 25 for November, 25 for December. With all of this going on, the 3-month, 10-year yield curve, the 3-month is still inverted. You can still lend your money for 3 months at a higher rate than what you can get for 10 years. It's still inverted. And so despite what the Fed is saying about wanting to stop any further weakness in the labor market, words directly from Jerome Powell, besides that claim, the Fed is still restrictive. The Fed funds rate is still above the rest of the curve. The Fed is still strangling the economy while saying on the other side of their mouth that they're worried about the labor market. With all of this combined, the crystal ball reading remains bear market very soon. I am also of the belief that the Fed will not cut fast enough to save the economy, while the hiking cycle did not slow down the economy as much as was expected. So they hiked way further than they thought they had to. Part of the reason it was less effective is because the U.S. has way more debt than it's ever had compared to GDP. And so we're closer to something called fiscal dominance. And when we're in fiscal dominance mode, monetary policies are less effective. And so while hiking doesn't slow down the economy as much, cutting may also have less of an effect. And in fact, one of the really funny things about the cutting cycle is that it actually, in some ways, slows down the economy. Think about all of the people with, like you've probably heard in the news, record amounts of money in money market funds. Well, guess what? That 5% that they were getting is getting directly cut down by the Fed. These T-bills are paying out less and less with every cut. So while it makes it easier for certain entities to borrow money cheaper, it also sort of turns the spigot off for the free money, for all, the high rate of return on free money for people and corporations with large amounts of money, sitting in T-bills. On to the charts. The CNN Fear and Greed Index very expectedly went into full throttle, extreme greed mode. The much bigger and more important bond market being closed today allowed stocks to get even dumber than they normally get. Next, we'll take a look at the S&P 500 itself. The SPX, if you've been watching the show, you know that I said that it's just simply looking bullish. We're at all-time highs and continuing higher and continuing higher. And so when will it end? Well, we're pretty close to that all-important, 6,000 number. There are technicians saying that based on a measured move from the COVID low to the high and then the low of 22 to now, the new high would be actually around 6,100. I'm not investing in this. This is like gambling to me. These stocks are too expensive for me. I don't play games like that. Next chart I wanted to bring up that caught my eye today was Bitcoin getting a pretty major bid today, rising close to or at the top of this channel that we've been building up here. Does it have legs to move above this channel? If it does, I don't think it wouldn't surprise me if we go up to the $100,000 level from there. I don't know if it can do that or not, but today showed a lot of strength, up 4.88% so far for the day. Oil, which oftentimes leads yields on treasuries, notably dropped today significantly, almost 4%, so 3.76% today. Large move to the downside. This is typically good for treasury bonds, as yields typically follow oil. I haven't been seeing much news myself about what's going on in the Middle East. Maybe things are cooling off, but yeah, so yeah, we might actually have a bottom in TLT now. I'm not even going to bring the chart up again. With the bond market actually being closed, let's wait till tomorrow to see what's really going on. Last chart of the day, I kind of should have brought this up earlier in the show because of its significance. This is from tradingeconomics.com, the website. It shows an index called the United States Leading Index. And before we look at the chart, let's read the description. So it's a predictive variable that anticipates or leads turning points in the business cycle by around 7 months. The 10 components of the leading economic index for the U.S. include average weekly hours in manufacturing, average weekly initial claims for unemployment insurance, so jobless claims, manufacturers' new orders for consumer goods and materials, the index of new orders, manufacturers' new orders for non-defense capital goods excluding aircraft orders, building permits for new private housing units, the S&P 500 index of stock prices, leading credit index interest rate spread between the 10-year bonds minus the federal funds rate, and the average consumer expectations for business conditions. I believe that they're talking about the Michigan survey. Seems like a worthy index to pay attention to that kind of puts all of this data together and says, okay, this is where turning points might be in the business cycle. So there's a few very odd things about this chart that I want to mention. First of all, let's take a look at the Great Financial Crisis. So when this thing started turning over, that this is middle of 2007, that's really when the stock market had peaked and started going down. And then we hit a bottom around the bottom of this dip here on this leading index chart. Beginning of 2009, where it would have been a great time to buy stocks. Similarly, after that with the dot-com bust, this is again not a perfect indication of where the stock market is going to go, but typically when this goes down, it means that things are getting worse, and then when you get to a bottom, that's when things have a chance at recovering. I point this out only because very recently, if you remember, it was around right at the peak here of 21-22, end of 21, beginning of 22. Looking at that date in the S&P 500, we had a peak in the stock market and it dropped off. And now, expectedly, the leading index also dropped off. Let's see if I can scroll in a little bit here, see it better. It also went down. Now, since then, we've had this epic rally in the stock market from October 2022 until today, just going straight up, absolutely straight up, all while the leading index has been continuing to go down and down and down and down. Now, almost all of these turning points where we go down typically have the stock market go down, and the bottom ends up being where it pivots, like the bottom of the chart suggests. And we have been dropping like a stone, yet the stock market is just going up higher and higher and higher, amazingly. And if I scroll into a 3-year period of this has been going straight down, looking like it's never going to stop going down. If it continues to go lower, it would give a lot of weight to the idea that, well, it adds to my daily reminders. It gives me more support on the bear side of the market, that the market is way overly optimistic compared to a lot of data out there. Now, with that said, if this starts going up the other way, if this starts going higher, 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 month after month after month, this, I hate to say it, this will give legs to the S&P 500 to rise. But we need to see it. We need to see it bottom and turn the other way, and we haven't seen that yet. Scrolling in even further, you can see it even more clearly. Each bar at this, with this viewpoint of looking at it, representing 1 month. The most recent of this being August, still lower than July. Scrolling back out, the other just big notable thing about this is that we're actually lower. Oh, sorry, I need to look at the 5-year. Sorry for jumping around so much. We are lower on this most previous reading of August 2024 at 100.2. We're lower than we were in April of 2020 when that was the most previous low. We're actually lower than that in this reading right now, today. Scrolling back out, I also want to note how much this has dropped. This is a big drop. This isn't like a little dip of 1990. This isn't like a little blip in 1995, 96, or from 98 to 99. Just a little tiny turn down. This is a massive move to the downside, all while stocks are ripping higher, and Mr. Market has his foot on the pedal to the metal in extreme greed. What could possibly go wrong, folks? I don't know. I'm just the guy with the crystal ball. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Rob's Child.